after 2 years to remove these curbs from HDFC Bank. Of course, HDFC Bank had a very different issue on their net banking. So I see these curbs getting removed when Kotak Mahindra Bank fully convinces.
That was Aditya Shah, but we're also getting the fourth quarter results of Hindustan Unilever, and we're just starting out with the press conference here.
Talk about financial year 23-24 performance. We delivered a resilient performance with an underlying sales growth of 3% and underlying volume growth of 2%. EBITDA margin was up 40 BPS year on year. We continue to focus on operational excellence and build back gross margins with a 430 BPS increase year on year. Net profit crossed 10,000 crore milestone in this fiscal. Profit after tax before exceptional items and EPS grew at 4% and 2% respectively. To serve the evolving aspirations of Indian consumers, we have embarked on our journey of transform to outperform. We have 4 key thrusts. A, growing our core through unmissable brand superiority. B, market making and premiumizing our portfolio. C, reshaping our portfolio to high growth spaces. And D, leadership in channels of the future. These 4 thrusts, backed by our distinctive capabilities, will enable us to continue winning in the Indian FMCG sector. Let me talk briefly about the progress we have made in each of these. We are a powerhouse of big purposeful brands. We have a total 19 brands clocking over 1,000 crore turnover each annually. Put together, these 19 brand account for 80% of our turnover. During the year, we have focused on contemporizing our master brands through the lens of unmissable brand superiority to serve evolving consumer needs. We continue to invest disproportionately in market making and premiumization. We have not only seeded categories and formats, but have successfully built them to scale. This portfolio contributes to more than 25% of our business and has grown double-digit in this financial year. Moving on to an update on reshaping our portfolio in beauty. We are focusing on, number 1, contemporizing our master brands. Number 2, investing behind 6 identified high-growth demand spaces like sunscare, facial cleansing, and serum. We have built a strong 2,000 crore plus portfolio across these big bets, growing handsomely, and we continue to scale them up. And 3, embedding capabilities across supply chain, mental reach and media models, and thought leadership. Through these actions, we aim to build a future-fit portfolio and capabilities that will enable us to meet the evolving needs of Indian beauty consumers. Coming to winning with customers, our effective coverage and assortment both have seen a steady rise at 1.2 times and 1.25 times financial year 20 levels respectively. Our eB2B app Shikhar continues to be a strong point of differentiation for us, and we have now successfully onboarded 1.3 million stores on Shikhar till now. We have elevated our execution excellence by amplifying our in-store activations and partnerships with customers in modern trade and e-commerce. As a result, our focus action, we have increased our on-shelf availability by 200 BPS in modern trade and online availability by 500 BPS in e-commerce. Considering our performance in the year, the Board of Directors have proposed a final dividend of Rs 24 per share, along with the interim dividend of Rs 18 per share. The total dividend for this year is Rs 42 per share, which is an 8% year-on-year increase. Moving on to March quarter 24 results. Underlying volume growth was 2% in the quarter. Pricing continued to be marginally negative, leading to underlying sales growth of 1%. EBITDA margin at 23.4% remained healthy. Profit after tax before exceptional items and profit after tax declined 3% and 6% year-on-year respectively. Coming to performance across the 3 segments, home care and beauty and personal care segments continue to see negative price growth in the quarter. Home care grew 1% with mid-single digit volume growth. BPC underlying sales growth declined by 2% with volumes remaining flat. Foods and refreshment, on the other hand, had positive pricing and delivered mid-single digit USG with flat volumes. Overall, 75% of our business is growing volumes. In fact, 50% is growing volumes in mid to high single digit. Margins in all 3 segments remained healthy, with home care and foods and refreshment at 19% and beauty and personal care at 26%. Next, let me elaborate on EBITDA margin delivery for the quarter. EBITDA is at a healthy level of 23.4% despite headwinds. Gross margins at 51.3% has improved 350 BPS through our end-to-end net productivity program. A&P at 10.8% is up 200 BPS as we continue to step up investments behind our brands, including in digital media. Employee benefit and other expenses at 18% is up 120 BPS year-on-year. On a full-year basis, these costs are in line with our long-term trends. The termination of consignment sales agreement with GSK will have an impact of 60 BPS starting this quarter. Let me now move on to our outlook. We expect FMCG demand to continue improving gradually. Forecasts of above normal monsoons and improving macroeconomic indicators augur well. We expect our price growth to be low single-digit decline in near term. If commodity prices remain where they are, we envisage price growth to plateau in mid-term and price to become positive in low single-digit range by the end of this financial year. We will continue to generate savings through our productivity program and reinvest it behind our brands and long-term strategic capabilities, while maintaining EBITDA margin at current levels. While we expect near-term demand to recover gradually, we remain very confident of mid to long-term opportunity in Indian FMCG market. India's booming economy, expanding affluent population, accelerating digital transformation, coupled with under-indexed FMCG spends, will provide companies with a strong runway for growth. With our distinctive capabilities and our strategic thrust of transform to outperform, HUL is well placed to capture this opportunity. With this, we complete our prepared remarks and I'll take questions.
First up, the numbers are absolutely in line with what the street was anticipating. That's not to say that the street was anticipating much. My question is a two-part question. The first one is on macros itself. At what level is your confidence as compared to a couple of quarters ago when it comes to volume recovery in the industry? And the second part, more specific to parts of your portfolio. One, at what level of discussions or deliberations are you on your ice cream business? And secondly, with Horlicks, what's the prognosis here with what has happened with regards to it being taken off the health drinks from a lot of these e-commerce platforms? So what your strategy is here?
So let me cover macro and Horlicks and I'll give ice cream to you. So overall on macro, the way we see on rural, we had spoken about that rural usually is always accretive to FMCG demand. And we had seen that was an area of overall business which had seen in macroeconomics, given the amount of cumulative inflation and the demand outlook, we've seen a purge of disposable income. And hence we've seen rural demand coming off. That we've started to see gradual recovery as we had expected. Is it playing the role of being accretive to FMCG? Answer is no. But is it improving sequentially? Answer is yes. The hope with we have seen good forecast for monsoon and with overall macroeconomics, I do expect that recovery to continue to happen. What is leading the growth for FMCG this point in time is urban. What is leading growth is organized sector, which is modern trade and e-commerce. What is leading growth is premium. In that part of the business, we have seen growths have come back properly, and we've done pretty good job as Hindustan Unilever in those parts of the portfolio. And hence the key watch out will be continued recovery of overall FMCG, especially the rural demand from where it is. Coming to a question of Horlicks, overall we have grown pretty decent again in this quarter, driven by volume growth and limited amount of price growth, which was the reason of we had spoken about commodity price increases in barley, wheat, and milk, which has started to plateau down. So we have some amount of price growth and volume growth put together. We have grown in high single digit in Horlicks. So it's a portfolio where the job of making the portfolio stronger, the plus range which we have activated across the country, the margin job that we had in terms of unlocking operating efficiencies, all those have been done very well. And we do believe where we are with increased penetration that we have done in the last few years and improved market share, this business is yielding good results. As we spoken last time, the key focus for us is to keep driving consumption. And hence entire home to home and building consumption is our focus priority now.
No change of perception due to all that has happened with regards to all these MFDs, where they are looked at, there is a lot of sugar in it, etc. It's not as healthy.
Functional nutrition is important for the community. We know that large part of even the more urban population is deficient macronutrients. So the category has a clear role in the life of the Indian consumer. It's still underpenetrated. For instance, our portfolio, which is the high science adult functional portfolio, is already in excess of 500 crores and is going very, very well. So we are serving, and so far as sugar is concerned, we have in any serving of Horlicks, far less than a teaspoonful of sugar, added sugar. There's of course sugar that comes with the preparation itself, but The added sugar is amongst the least in the industry. So I don't think this is of material significance to us. And also the recent discussion is more to do with infant category, which we don't participate in.
Right. I just want to know, is there any conversation you're having with any of the authorities for that? Because, yes, there is some sugar content in all of this, but is there some rule requirement that is there from any of the authorities?
We are fully compliant with FSSAI, but also Unilever nutritional standards to the highest degree, and it's all fully compliant. So our job is to essentially grow the business by serving our consumer, and we are growing penetration in nutritional functional drinks. We are growing market shares. Our recent moves have been yielding results, and as I said in the previous conversations, we have to stay the course. There's a long runway for this category, but it requires us to stay disciplined, and particularly the more premium end of the category is growing very well. And we're very excited about that opportunity, whether it's women's health or diabetes and other conditions that we are helping solve. Yeah.
So on the ice cream business, if you can throw some light on how has been the performance during the year, as well as any material update that you have so far with regards to your parent, deciding to get rid of the business. So
yes, if you pull back and look at ice cream over the last 4 or 5 years, we've had a very strong clip of growth. It's not surprising. We're a leading player in the industry. We've been in decades in the market. The ice cream market is sizable by scale for our income status as a country. Therefore, the opportunity in the headspace for ice cream as the country gets more affluent, as people consume more food out of home, impulse is only strong. And we're all in at this point to sell in for the summer, which, as you know, is going to be nice and warm. And we are at this stage focused on just doing that, innovating aggressively and making sure that our products are available across the length and width of the country. Specifically to your point about the Unilever's position on ice cream, we are under evaluation, exploring all options with our board, HUL's board and the management. And when we have clarity on where we want to go with it and we will have a clear position, we'll come to you. But at this stage, it's all under evaluation.
okay. On the raw material side, I would like to know, there are a few raw materials like coffee, they have seen a significant uptick. How has been the impact on your numbers? And also, as we speak, what is the kind of trends that you're seeing in terms of your key raw materials?
So overall commodity, the entire financial year, last financial year, 2023, we had seen material amount of inflation. All 4 quarters of this financial year, 23-24, we have seen deflation. And the 3 big areas where we have our business exposed to is crude oil, is crude palm oil, and tea. All these 3 commodities are deflating. Food commodities are the ones which started to inflate much later than these commodities, and even there we now have seen sequential trends have plateaued down. Skimmed milk powder is also now on a deflation year on year. The exception this point in time where we're still seeing substantial inflation, exactly to your point, is coffee. Coffee is a place where we have taken price increases. Our growth of double digit in coffee is a price-led growth where volumes are getting impacted with a substantial amount of inflation. Over the last 2 to 2.5 years, we've seen 70% inflation in coffee prices. So rest of the portfolio outside that now, as I mentioned, there's an overall at an aggregate level a deflation in the business this point in time. And which is why all the pricing actions that we have done, remember we never priced to the peak of inflation, and we were very measured about it. In small chunks we took price increases, and as commodity prices started to come down, then we also then took our prices down as well in the last few quarters.
So is it right to assume that in the food and refreshment category you will continue to take price hike, and the other category like home care and personal care will see price cuts, given that it has been deflationary?
Let me answer this with little more details so that we all get it right. Home care and personal care, this is where we have seen year-on-year deflation. We have completed all the pricing actions of taking price corrections to ensure that wherever commodities have fallen down, we have passed on the benefits back to the consumer. The last area which we have finished doing correction in this quarter is in mass skin cleansing. Even there we have now gone ahead and done the correction. Overall FNR commodities, they are not inflating sequentially. So whatever pricing actions which we had to take, we already have done a couple of quarters ago. We don't need to do anything sequentially more. Coffee is the only commodity I mentioned where we have seen sequential inflation and where we have done pricing. And we have, of course, got to watch going forward what happens to it. And that's, of course, a small portion of the business. So by and large, bulk of the portfolio, whatever we had to do on pricing, sequentially, we have done that, both in terms of increase in FNR or in terms of decreasing price in home care and personal care. and which is why the outlook, sorry, just to complete as mentioned, if prices remain where they are in commodities, we expect in short term to have marginal decline in our pricing. It will plateau down in our midterm, and in the second half of the financial year, we expect low single-digit price increase.
So on premium personal care in particular, beauty and wellness, from the next quarter onwards, you will have reorganized your business in that manner. The street is a little more aware of how this performance or this part is performing by virtue of the listing of a D2C beauty and personal care player recently. On those comparable products, has your growth been higher than them?
I don't want to speak to other competitors. All I can tell you is that we're gaining market share. First of all, yes, we are growing we're growing robustly, well into double digits and beyond in our premium skincare portfolio. We are growing well ahead of the platforms in the platforms we compete. We're gaining market share. We're very excited with how our innovations are performing. We're very, very focused. In fact, we have 6 multi-year bets, sunscreen as one, or facial cleansing as another, and light hydration and so on and so forth. And if you just take the bets that we have chosen to compete on, they by themselves are close to almost 2,000 crores in scale and are growing well over 50% in e-commerce.
Have you been struggling with your personal finances? You're not alone. There are a lot of people out there that find it difficult to manage their money. But on Big Decisions, we'll be discussing a variety of topics that will help you make your financial decisions with confidence. Check it out on any of our social media platforms, the television channel, on the website ndtvprofit.com, or in fact, on any of the podcast platforms out there.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some
It's been a great quarter for Cyient, actually. They've managed to pull it off. The management had committed to a 40% growth YOY. They've actually beaten that by growing 43% in FY24. We have the management with us joining in to give us a sense of what lies ahead for the company. Anthony Montalbano, CEO of Cyient DLM, now joins in. Anthony, very good morning. Thank you for joining us. This is the very first time we are talking to you, and it'll be interesting to hear from you of how things are looking at Cyient. You've guided, or rather had guided, for a 40% growth in FY24. You've beaten that quite well, clocking in 43% in this current year. We are entering FY25 on a higher base. What is the growth that we can expect? Do you think a 40% in FY25 is likely from your stable?
Yeah, so Semi, it's very nice to be here. And yes, this was a very strong year for us in terms of overall business growth. And, the guidance that we have given and continue to provide is we anticipate, over a 3-year CAGR term about, an average of around 30%. And so that can vary a bit year on year. So this is, we are pleased with the results of this last year, and then the outlook as well is in line with delivering that CAGR over a 3-year period.
Okay, so fair to assume that your guidance largely remains the same, with a little bit of an upside bias from what we've already seen in FY24. In terms of revenue growth, where does it largely come from? I know aerospace and defense has been growing significantly over the last couple of quarters, but you have maintained that medical, medtech and industrial is a space that you're pushing hard on. So in terms of revenue split up, what led to this growth this quarter?
Yeah, so this quarter, and even a lot of this fiscal year, we did have a very high percentage of aero and defense business. And this is a core. It is a core competency, and it's an area that we excel in the industry at. Now, we have had a higher percentage in medical in prior years, and we see that shifting where we expect medical and industrial segments to start to gain larger share. And so, we are quite happy, to be honest, with the concentration in aero and defense, because those have been very good sectors in general, and the outlook for those sectors remains very strong. So there is a focus to diversify, but we're not shy about aero and defense being a prominent area for us.
Staying with aero and defense, and Israel is a prominent market for you. With everything that's happening on that front, I know there were Red Sea, because of the Red Sea, there was some delays as well, but you managed it pretty well at a company level. But at the flip of it, right, with the uncertainty rising in Israel, Iran, the geopolitical tension there, has it impacted your order book positively in any way? Has it led to more conversations? Has it led to existing customers and clients increasing their allocations to you?
Yeah, so, when this initially broke out, and actually it was not long after I even made a trip to the region myself for the first time. And so there was initial concern about supply chain potential disruptions. We immediately reached out to our top partners in that area. And we've seen very little, if any, disruptions in that regard. So which has also allowed us to deliver the results that we have. So, from a stability standpoint, we have been seeing very solid reassurance in that regard. As far as to your question regarding the outlook, we have seen an increase as well in demand on these types of programs from our clients in that region. So there is an upside on that side of the business as well. And that is something that will continue to grow here in the coming years.
Could you quantify that upside, and also tell me that is this transitional? Because once, of course, the geopolitical stress is behind us, hopefully sooner than later, what does it then do to your orders or revenue?
Yeah, it's so we only have a couple key clients in that region. Right. So it's hard to really get a trend. So in general, we were executing a couple large programs in that region. And we expect that those programs will continue. And then we've also had some newer clients where we started the business, and that is accelerating more rapidly. Right. So when I say, upside, we had a certain value budgeted for a particular client, and we ended up exceeding that. And then even as we do our budgeting and outlook for this, the next fiscal year that we've already begun, we see we've made the appropriate adjustments in that regard. So it definitely is having some movement there. But again, it's, relative to our overall business, I would call it not even a modest, a little bit more than minor, but not even a modest impact, because again, that's just, a couple clients in one region.
Okay, let's move on to margins. Q1Q, there's an improvement. Margins had dipped to levels of 9%. You're back at 10.5%. Last year, of course, in the same quarter, you clocked 11.5% margins. You did say a lot of that was also transitional, so things will get better as we go into FY25. Is it a fair assumption for us to make that over the next couple of quarters, you will return back to 11-12% margins?
Yeah, our goal from a margin perspective is to operate the business at double-digit margins, right? And I think what that means is that can mean somewhere of 10 to 12% is ideal. There can down the road be upside beyond that. But we've also in parts of this last fiscal year have come in the 9s. And so, part of that is really due to a couple main things. One is your business mix. We've had some larger defense programs that were a little bit lower margins. So that business mix kind of brought down the margins a bit. And then we've also made some investments, right? We've made announcements. We opened a new facility in Mysore. that we announced just a couple weeks back. We also opened a new facility in Bangalore, and then we've also made investments in supply chain and also in our chief technology office. So these types of investments as well kind of get timed throughout the year. So as we finish Q4, you see that we are back into double-digit margins, and you will see Q on Q variability in that range. But that just kind of gives you a view on this. And then as we go down a couple years and as we continue to have the growth rates, there'll be more absorption, and then we can look at further upside at that point.
Right. I want to talk about the international business. I know you've talked about inorganic acquisitions, and I'll get an update from you on that. But just before we go to that,
Yes.
What is the percentage contribution coming in from the international business and back home as well, with the government's trust on defense, infrastructure, railways, tech,
Right.
which are a few segments that you focus on pretty significantly.
Right.
What is working for you in India? Do you expect that to be a multi-year sort of growth story which you would be able to benefit from in India, and of course globally as well, where things stand?
Yeah, so I would kind of break that down in two ways. One is just from a revenue perspective. Right now it's about 1/3 is within India and 2/3 are outside, primarily Europe and US. And that 1/3 within India is largely made up of some defense programs, key defense programs that we have going right now. And so as those programs, ramp down, other business ramps up, we kind of maybe see that shift as far as where the clients are to maybe be a little bit more 2/3, a little heavier going, outside of India. That being said, we have invested in go-to-market and focus on clients in region to grow that. And so we will see some of that impact. But if you also just look at our client count, if you take like our top 10 clients, even top 20, most of them are from Western countries, from US and Europe. And we anticipate that a large portion of our business will be grown from those regions, those clients. But of course, we'll deliver that revenue and business from India, right? Today we are contained within India operationally, and even as we look to expand outside of India, India will still be our core. And as we look outside, that would then bring additional opportunities that we might not have sight of today within India.
Makes complete sense. And you mentioned this last quarter as well, where you were very keen on inorganic expansion, and you were eyeing, opportunities to acquire outside the country. Any update on that? The last quarter, you were pretty clear that those conversations were fructifying. You want to bring us up to speed with what's the latest? How did that deal go?
So what I can disclose is that we are actually quite pleased with the progress, and we will be making. We're planning to make some announcements and updates in that regard as soon as we get through some key milestones. So our strategy overall is to provide that expansion. Not just from a geography perspective, but also from a capabilities perspective, right? So, for us, especially outside of India, when you look at the inorganic piece, it's important to have the top line and bottom line performance aligned with our type of business mix, so it's not dilutive. And so, getting those stars to align, it takes a bit of work, but we have, what I will say is that we are very pleased with the progress we've made. This is not just a one-off type discussion as well. This will be a continual part of our inorganic strategy. And I hope to provide some more details here, most likely by next quarter on specifics, which I'd love to share with you and our clients as well.
For you, and I'm assuming that's going to be revenue accretive from the word get-go, right?
I would hope so. It would absolutely have to be. Yes.
How are you looking to fund this